This is Jamie Nevers with Colorado Home Realty, and I am here with Nicole Rueth with Fairway Lending today, and we're going to talk about what it's like to buy a house post-quarantine. So thanks for joining me today.
Well, my pleasure. Thanks for having me.
Yeah, absolutely. So everybody's kind of coming out of the quarantine and looking at houses again. Showings have skyrocketed, but I know a lot of buyers aren't able to qualify anymore, and they may not even be aware of it. So I wanted to ask you a couple of questions about what does it really look like to buy today?
Yes, it's a great question because with the change, right, with being furloughed or being on unemployment or changing jobs or going back out looking for another job, we're getting a lot of those questions. People are trying to figure out, can I still buy a home? And it especially hurts when you were in the middle of buying a home when all this happened. But certainly there's opportunities for people after COVID.
Awesome.
Yeah.
So what about like minimum FICO scores, as far as like the things that people had that were solid before, what has changed in that regard?
So I would say that anybody that was pre-approved before should get pre-approved today. And then I'm also going to tell you that not every lender is doing the same thing. So the guidelines for Fannie Mae, Freddie Mac, as well as FHA, VA, and USDA haven't changed. Those guidelines are the same guidelines pre-COVID as they are currently. What's changed is the whole ripple effect, if you will, that forbearance caused on the servicing industry. And we might talk about that later, but to this point, that pain point on the service industry has backed up into the lending environment and created a cost, a real risk. So that cost has given each lender pause on what they can do or won't do. And so that's where each lender is slightly different. Some lenders have gone all the way up to 740 or 700 or 640, whatever that number is. So the conventional credit score is 620. And the FHA credit score is typically 580. They'll say it goes lower, but rarely could you get that. And VA is the same, 580. But what you're seeing today is you're seeing government closer to 620 to 640. You're seeing conventional, 640. So those things have pushed up. And then you're also seeing different credit scores depending on the product. Cash out refinance has a higher risk right now based on some of the actions taken by government. So those might be 660. It all depends on the lender you're working with. But just to kind of give you kind of insight into that, if you're working with a lender, it's good to chat with them again to see what the current eligibility is.
Mm-hmm. Yeah, that makes a lot of sense because I'm sure the lenders want to make sure that the loans that they're now going to write are going to be able to make their payments so that the people that aren't making their payments, they can kind of even out and spread out the risk.
Right.
Okay. So a lot of people have lost their jobs. Obviously, unemployment has gone up significantly. So if people are coming back to work now, there's a gap period, they've been furloughed, or, they had unemployment income for a little while. What does that look like for them moving forward?
So unemployment cannot be used as qualifying income, although it can be in certain circumstances where it's tapped into seasonal work. So you might have forest workers or people that can only work 3 seasons a year, and every 4th season they go into unemployment. Well, if we see that over 2 or 3 years, that unemployment is part of your seasonal income, interestingly enough. But that's not this. This unemployment isn't being added to or looked at as seasonal. So it's being stripped out. So you'll have to qualify for whatever income that you've earned and or will continue to earn, which is impacting people that were maybe hourly, that their hours got dropped, and certainly those people that are on furlough. But if you're on furlough or if your hours were dropped, we're telling those people, well, you'll have to wait until you become eligible again when you go back to work. But as soon as you do, you can qualify, especially if you're on any kind of salary or full-time. If you're part-time, we'll look at your average of hours pre and then post. The during, obviously, we know is down. FHA has a guideline that says that if you've been off work for 6 months, you have to be back to work for 6 months. So if someone is furloughed for 6 months, that might become a problem. Right now, we're looking at more like 45 days. Conventional doesn't have that same guideline. So if you're getting a conventional loan, we just have to have a letter of explanation in the file, and we're fine as soon as you go back to work.
Okay. Okay, that makes a lot of sense. So what if somebody lost their job and then now they're, pursuing something that they weren't doing before?
Yeah, that's a great question too. It depends on how different it is. So one of the things, and again, this is a guideline that's always been around. So we haven't changed too much of that. We just have to look at everything through a different set of lenses. So the guideline, if you change careers, let's just say an example. If I was self-employed as a photographer and I was making $15,000 a year net, right? Because of course I could write off everything, no matter how much I made. Maybe I net out 15,000, but then I get this great job, and maybe it's even part of a photography studio, but now I'm making 60,000. Well, an underwriter's going to look at that and go, that discrepancy is pretty wide. Did they get that job through a friend in order to qualify? That question existed before and it's going to exist after. So they're going to have to prove that they're really going to stay there. Sometimes an underwriter can ask again for that 6 months. Let's just say you stay in that job before it changes. But if you go from one similar level job, some entry level job, maybe you were an office manager or a factory employee or a store clerk. I could go on, and there's, every tier kind of has similar type jobs, and you just move from one similar type job with a similar type of income into a similar type job, then we're not gonna have any problems. We're gonna be able to get you approved for that. So it's definitely circumstance appropriate.
Yeah, it sounds like there's a lot more wiggle room with the way that they're going to kind of look at things. But that letter of explanation is a great way to, kind of bridge that gap and help people understand.
Right. We definitely need to understand what's going on. You can't assume anything. In fact, I never want my underwriters to assume anything, no matter what the timeline is, right? And whether we're in COVID or not, but painting that picture really well and tying it. I had 2 kids. This goes back a little bit, but this shows you how much of a leap you can do. They weren't even getting paid. They were working internationally. They were teaching classes to a technology group. They came back to the States and they were working as consultants, making a salary. And we were able to tie the fact that they were teaching technology classes. It only made sense that they'd come back and be consultants. It's similar enough, right? So yeah. A good letter of explanation goes a long way.
Okay, great. Well, I think that that's hopeful for people that are experiencing this transitional period.
Yes.
The last question that I have really is about forbearance. I think that a lot of people jumped into it really before we even knew what the ramifications looked like. And what does it look like coming out the other side of that?
Gosh, that's a challenging question, right? And it's getting redefined as we talk. So I will tell you what it is today. And they're talking about trying to change it. Whether or not they actually do, I don't know. I'm not holding my breath yet. But it's really easy to get into forbearance. It's almost too easy. The way the CARES Act was written, it really didn't assume this moral compass that had to be in alignment for everybody to make the right decision. What does that mean? So the people that really needed it, take it. The people that didn't, that wanted to just create liquidity, I don't disagree with their argument, right? It kind of made sense. You're going into this unknown period. So maybe you just wanted to keep your money in your savings account and knowing that you'll catch up in 4 months when your time runs out and the economy's back to normal and you're back to work. It's logical. But the problem is nobody really talked about, well, what does that look like to get out of it? Well, there's a couple of ways that you can get out working with your servicer. You can either 1, pay it all up front. 2, you can do a repayment plan. 3, you can do add it to the end. There's certain circumstances that have to apply for that. And then 4, a loan modification. All of those are in conjunction with your servicer. You don't get to choose. You don't go, can you just tack it onto the end? It's a conversation. The servicer has to agree to that. The problem is the CARES Act did not set out a plan for what a forbearance means. They said specifically that it was not going to affect your credit score. They did not say that it could not be reported to your credit. And it is. It's being reported, and we're now seeing it. It takes a little bit of time to catch up. So now we're seeing that the banks and the servicers are putting that on your credit report. And the moment you put forbearance on your credit report, now if I go back to my guidelines, which I said earlier are the same guidelines that we were living under before, that forbearance is actually, it's a risk factor that then has consequences. If you go into forbearance on anything, student loans, car payments, houses, the way the guidelines are written is that forbearance needs you to bring it up current and then show 12 months of payment history that you can maintain that current status. So that wasn't thought through nor changed. So right now that's the guidelines. That's where we're questioning, will they allow for the forbearance with paperwork documentation that shows that you were affected by COVID, and will that forbearance be waived for those people? It's yet to be decided. That's some of the whisperings I'm hearing, but it's going to take some proving that it impacted you, if it even goes there. But right now, everybody that has a forbearance, whether or not they needed it, whether or not they even took it, even if they just inquired about it or got approved for it, they're locked out of the market for 12 months. They can't refinance or purchase.
Yeah, so that's another question that I just thought of as you're talking through this is, rates have been really low. And I know that right now, today, I got quoted a lower rate than I did before the quarantine happened. So if somebody does go through forbearance and then they have to wait, 12 months, so they're 14 or 15 months out from right now, do you foresee rates being as low so that they can, kind of take advantage of what has happened? Yeah. Or do you think that it's going to be a different world then?
So regretfully, my crystal ball broke a long time ago.
Yeah.
I will say that this is going to take years. It's not going to take months. I wish it would only take months. I think we'll bounce back from it relatively quickly in retrospect. So it will be, if we drop this much in GDP or unemployment, and then we came back halfway or 40%, that's going to feel huge. It's not going to be drop and then stay low for years. So it's going to take some time, but we're going to creep back up as people can go back to work, as businesses reopen or businesses shut down entirely and those people get reabsorbed elsewhere. So there's opportunities, but you can't destroy the airlines like you did in the entertainment, and how long before we can go see a concert or a stadium sports event. So it's going to take a while. So I think we're going to have low interest rates. It wouldn't surprise me for a couple of years. So I wouldn't lose sleep over it. Obviously, it's not ideal. It's something that was done that has consequences, but it's not a forever thing. You're just going to have to hold on until you run out of that time.
Yeah. Well, thank you so much for all this information. I feel like there's so much misinformation, or, somebody sees Chase is making a move in the marketplace and then they think every lender is doing that. So thank you for taking the time to really clear it up and let us know what's going on out on the street.
Absolutely. Thank you for having me.
Yeah, absolutely.
Bye-bye.